I lost 1/3 of my savings in a single bet. Not because the market crashed, not because the company failed, but because I broke the cardinal rule of position sizing. So I didn't upload that video for like, I think probably half a year, just because how bad I look in that and how complicated it's written. But there's just so much valuable stuff in there. So I decided to post anyway, and I really want to see my own progress. So that's why I'm just putting it out. Probably the most important thing I've learned from that is go on fucking vacation if you look like that. You cannot see in the next shot like how I looked after like 2 days. So hope you learned something from it. Hi, I'm Andy. I've worked with a trader turned family office for almost 7 years. The best environment to learn how to make money with investing. And this was my most expensive mistake ever. It taught me position sizing. Here's what happened in my framework to never do this again. And also a real life application, a junior mining investment case. It helped me a lot. I hope it helps you too and saves you some money. Here's the painful math. 90% of startups completely fail. Only 1.5% ever exit above 50 million. Yet I bet 33% of my portfolio on one moonshot. Pure delusion? When you're convinced that the odds are in your favor, sizing up is a must. Stanley Druckenmiller says sizing is 70 to 80% of the equation. But here's the trap. I confused conviction with probability. While I was dreaming of a unicorn, the cold statistics told a totally different picture. A success rate of probably less than 1% doesn't really justify a 33% position, not even close. Let's break down the math. Position size, 33% of my portfolio on one bet. This mathematically implies an average win rate of such an investment would have to be 66%, which we obviously know it isn't. This would mean a mathematical optimal allocation of less than percent of the portfolio. This means I overbet by 6,600 times. But the only real mistake is the one from which we learn nothing. So I turned my X-figure lesson into a masterclass on psychology and position sizing. Here's what I discovered. I'd fallen for the matching bias, that sneaky mental trap where you assume your gut feeling resembles the real life. I only used the information that I knew, but the truth was still totally in the dark for me. This revelation led me to Daniel Kahneman, the Nobel laureate who studies for decades why smart people make dumb decisions. He shows a systematic way how to bridge the gap between intuition and reality. I've distilled his insights in a framework so practical, so powerful that I now use it on every single trade. The best part, it doesn't kill conviction, it just calibrates it. Let me show you the process. First, have a clear strategy for your investment. At least the following. At what price do you plan to sell if it goes well? Your potential loss. At what price do you plan to sell if it goes bad? Maximum loss you can handle with one investment. That's the amount where you just can handle if it goes to zero. And we know that stocks can go to zero. They do once in a while. For me personally, I decided to never go above 10%, but with that I already have to have very high conviction, and I also calculate half Kelly, which is a formula I use for position sizing, and whatever is lower of the two, that's what I'm gonna use as my maximum position size. Step number 2, make your intuitive guess on the success rate. How likely do you think this is going to succeed? Like, this is where you do your research and where you just write down what you think is the right thing. Step number 3, you look up the base rate, the statistical average, how likely it is that this investment is gonna turn out. Usually you do that by looking at data from the past with an investment strategy that is very, very similar to that what you're about to do. Then step number 4, estimate the diagnostic value of the information you have. How deep is your expertise in that area? What is your verified track record in investing? How's the track record of this exact investment strategy that you're about to perform? And where are your blind spots? You need to have those in mind. You need to be very honest to yourself. Step number 5, calibrate your position. This is where the rationality beats the emotions. And next step, we calculate how far we go from the statistical average, depending on how certain we are about our knowledge in the sector, more into the direction of our intuitive guess. So let's get practical. We're gonna apply that into a certain investment that I'm doing right now, which is in the junior mining sector where I'm currently investing a lot. And here's my exact process how to size a mining exploration bet. My strategy is I evaluated what I think is gonna happen, and my maximum position is gonna be 10% or half Kelly, whichever is smaller. My win target is 7x, which means a 600% gain. My loss limit is I'm gonna sell before I'm gonna have a 50% loss. And the thesis behind is that the company advances to the next development stage. So second step, my intuitive guess. After listening to their presentation and doing my research, I think the investment has a chance of 50% of being successful. But now let's look at the statistical average, the base rate of those kind of investments. For this, we need some research on how likely it is on average that those companies actually succeed to getting to the next stage. So let me share what Michael Williams, a successful investor and entrepreneur in the space who've created a lot of value for shareholders so far, told me about that.
You know, it depends. Like there's different types of geologists, for instance. There's exploration. People which are good at figuring out things from what we call grassroots, which is not a lot of work or no work has been done on a particular area, but conceptually it should host minerals. And they advance the project, they figure it out, and at the end of the day they put a drill in and make a discovery. That's, you know, that's a panacea. But at the same time, you know, sometimes like I like to buy a little bit more advanced projects and take them through what we call pre-feasibility study or to preliminary economic assessment. That takes more engineering and things of that nature.
We can break down the stages into 4 critical stages. There could be more, but we're trying to keep it simple here. There's the grassroots exploration. Imagine geologists with dreams and magnetic data sitting on their desks looking for the needle in the earth's haystack.
So for mining, the first thing you need to start with is to establish that there are metals present in the ground, and that involves what we call exploration. And that can sometimes take several years. There's a lot of work involved, a lot of professionals.
Maybe they're hiking through the mountains, picking up some rocks and looking at them pretty carefully and just judge if the colors that they see are meaningful or not. Then the next stage is the advanced exploration stage. This is where drill rigs actually hit the ground and ore is taken out of the ground to see what's in there.
And once you establish that there is metal in the ground, then you have to quantify that. A lot of studies involved to make sure you have continuity and it's going to be economic.
This is where we get proof of what's below the surface. The next stage is the development stage. This is where the engineering takes over and a mine is actually being built.
And then you have to build all the infrastructure, the mining infrastructure, processing plant, all that kind of thing. And then you actually start the mining process. So it can take many years, and it's very capital intensive, costs a lot of money to get started, and a lot of professionals involved. But it's a very exciting process, and something that I've really enjoyed for more than 45 years now.
This is where the geology is turned into economics. And the very last step that we're in is that we've got a profitable mine. This is where dirt becomes dividends. Finally, a product is being sold, cash comes in through revenues. But now about the odds. Here's what Michael told me about those.
I think there is a statistic for every 1,000 discoveries, one becomes a mine. I'm sure it's now 1,500 or 2,000 becomes a mine. Like that's how difficult it is, and just to show you where the commodity cycle is or where it's beginning. On the copper side, which copper's arguably the most important metal on the face of the earth, we've made since 1990 224 copper discoveries, only 10 in the last 10 years. So it's not an easy business, but there's scarcity.
It's depending on who you talk to, it'd be like 1 in 1,000 to 1 in 10,000. So again, that's the thing that investors who know nothing about exploration mining have to understand the risk.
After this conversation, I did some more research, and the most cited statistics that I could find confirm pretty much what he said. Out of 1,000 grassroots projects, about 10% advance to the next stage. This means 100 of those 1,000 are gonna be advanced targets. Out of those, only 10% are gonna become development projects. And out of those 10 that we're left with, only 10%, which is 1, it's gonna be a profitable mine. So if you invest very early, the statistics show that it's about 0.1%, 1 out of 1,000 projects that actually are gonna turn into a profitable mine. Rio Tinto, a major player in the space, suggests that it's only 1 out of 3,300. And some studies, like one from the Ontario Mining Association, suggests that only 1 in 10,000 projects reaches production. So it's very important to know what to look for. And I got another crucial insight from Michael about finding quality investments in the space.
There's 2,000 companies in Canada. There's probably 200 really good ones with either good assets or very prospective projects. So you're only looking at 10% of all the companies. You want to have a company that has a legitimate shot at success.
Now that we've got a clearer image on what the different stages are and the statistics, we can now take all of those data and enter them in our framework, how I would do that with that real investment. So my project's profile. Current stage, advanced exploration. The target of my investment, it's gonna turn into a development project. The statistical average based on the studies we've seen before is 5 to 10%. So I'm gonna go with the more conservative number of 5%. Step number 4, I gotta assess my edge. I got around 3 years of experience in mining investing and a few more years in general investing, but I definitely don't have any geologist credentials. I'm not a geologist, and neither have lived through a full market circle. I've got a solid understanding of company analysis, as I did that in my job, and I'm also a certified financial modeling valuation analyst, which gives me solid ground for reading financial statements and doing analysis. But now let's make the reality check. My gut says there's a 50% chance of success, but I gotta be honest with myself. I'm just gonna weigh my personal experience with like about 20%. So we start with the 5% base rate, and we go 20% of the difference of the 45%. And with that, we end up at exactly 9%, which is the probability we're gonna assume of chance of success. Now let's look at the math of this. Let's assume my portfolio is exactly 100,000. We do the half Kelly calculation with a 9% success rate with our 600% potential return or 50% loss. And this leaves us with an optimal position size of 1.4%, which would be $1,400. That's right. Despite my conviction, the math says 1,400, not the 33,000 my emotions might suggest. This isn't about being timid. It's about surviving long enough to catch the winners that matters. Because if you're broke before, you're not gonna have money to be there when there's actually returns together. I hope you learned something. If you have struggled understanding this, please write in the comments or contact me. I'm more than happy to help you out. Cheers.